Welcome back, everyone. Today is part 4 of the course where we'll be focusing on market conditions and market rhythm. The next video is going to be going into internal order flow versus external order flow. The following video, we're going to talk about key levels and liquidity. And then we're going to get to a section of how to put it all together, how to create a trade plan, and essentially what you can do to utilize everything I taught and what you can do to backtest and journal and refine your data. So the goal of all this is to make you guys self-sufficient, and obviously we will support you through the Momentum Market Edge calls on Sundays. If you already haven't, get the Trading Bible. I'll leave the description down below, and obviously get into Momentum's Discord, as you will have complete trader support from us. All right, guys, so let's dive in. When I say market conditions, not every market can be treated the same. So we have the first condition I'm going to talk about, which is CMC, and that is consolidating market conditions. Then we have a couple different types of CMC bearish and CMC bullish. So essentially you have 3 different consolidating market conditions. I'm going to kind of break them all down, show you the difference. And then we have trending market conditions. With that, we have trending efficient and trending inefficient. So when we're talking about gold and indices, they run inefficient most of the time. They don't gain efficiency all the time. When we're talking about pairs like Euro USD and GBP USD, they actually run efficient most of the time. So let's start with CMC. What does it look like? Essentially, the market's gonna create a range, and it's essentially just gonna be kind of stuck in what looks like a sideways consolidation. With these types of market conditions, you want to avoid trading in the middle. Anytime we have any kind of consolidation, we want to be trading the edges only. So this is basic CMC, consolidating market conditions. Some people call this liquidity markets. Some people call this a technicals only markets. Essentially, there's no fundamental drive, and this is where it's really easy to get wiped. So in conditions like this, I sit back a lot. So that's CMC. CMC bullish is essentially something along the lines of where you're barely breaking the highs and you're kind of heading up. So this won't always be exact. Like, it might even do something like this where it wicks below, but essentially you're still making highs. What's unique about these, usually I'll go to the 1 hour to find these conditions. When we have these breaks happen, it's generally just by one candle, and a lot of the times the candle will just be a wick or it'll barely body break. So what this does for us is it allows us to anticipate the market. If we do this once, we do this twice, what's the expectation from this point? To barely break it the 3rd time. So this would be a safe trade when these conditions are established. The next thing we have is CMC bearish, and it is essentially the reverse of what I just showed you, and it is barely breaking lows. Now, something with these conditions is you won't know it's happening right away until you get at least 2 breaks minimum. And the 3rd one is where the anticipation happens and you can have a higher probability short. What you got to keep in mind is what the market's actually doing is we're building liquidity here. When this takes out something of great value, like a daily external, weekly external, all this liquidity we built, they call this protected liquidity. We'll touch on that more in the liquidity section. When liquidity is built and it targets something and it takes something out, it loses its protection, meaning that if price starts coming back up here, depending on what else is going on, I would say it's safe to say that all of this liquidity is now targeted and it is basically now there for us to take. So it's important to understand with CMC bearish and bullish that liquidity is protected temporarily, and at some point we're going to be looking to take it out. This could take days, this could take weeks, maybe months. It's just important to understand it's there. There's more context when we go to put it all together. Then the last thing we have is the market conditions where the most money's made, and what you have is trending efficient And there's two ways to gain efficiency, which I'll talk about in a sec. And then we have trending inefficient, which is very common for gold and indices. So how can the market gain efficiency? So there's two ways. One, if this is the bottom, this is the top, we pull back to at least the 50. So that's one way of gaining efficiency. The other way is if the peaks and valleys touch, that's an efficient market. If the market's running efficient, it's less likely to pull back. If the market is running inefficient, it's more likely to pull back, and where you get something like this, and then the market continues. So that's essentially, in a nutshell, what the difference is between efficiency and inefficiency. Depending on what your trading asset is, like I said, EU, GU, they run efficient a lot. When you're talking about gold, mostly runs inefficient. What it'll do is it'll run inefficient for weeks or months and then maybe have a big price dump, regain efficiency, and essentially it will continue on in the same direction if the fundamentals drive it. Now today we won't touch too much about how the market gains efficiency and loses efficiency. I'm going to save that for the next section when we get into internal ranges and external ranges. Today what I do want to talk about though is the heartbeat of the market, or the rhythm of the market. I prefer the word rhythm. Some people like calling it the heartbeat. And the heartbeat is essentially exactly what I showed you here. Is the market really impulsing and barely pulling back and running? Or is the market having deep mitigations? If the market is mitigating over 50% or 50%, I would say that market is not aggressively trending. When gold is properly trending, it barely pulls back to the 50 ever. Usually it's the 382, the 236, and you're probably like, why is this important? I'm going to show you in a sec. Also, once we're done this, we'll go look at the chart stuff, so this will make more sense to you guys. On actual candles, I just need to show you how this works. Okay, so what is the heartbeat or the rhythm? This is essentially the idea behind it. Okay, this one didn't pull back to the 50, so now I'm gonna pull this one, this leg, and then all of a sudden, okay, well, it kind of pulled back somewhere between 236 and 382. So with this knowledge, this tells me one thing: the market crawling, is it walking, is it jogging, is it running? The deeper the mitigations I expect in the next legs. So as long as the conditions don't shift and the rhythm remains the same, it allows me to find high probability areas with more accuracy. So when I say high probability, okay, so we're looking somewhere in this vicinity. Here, we will be looking somewhere in this vicinity. So now, when the market is gonna pull back here, we're looking for a reaction somewhere in this vicinity. And when we get to the key levels section, we'll talk about how to line up the levels as well. So this allows me to anticipate a move like this and continue on up. Now, I don't expect price to be like, well, it hit the 236, it hit the 236, I expect the 236. What I'm mainly looking at is, are we reacting above the 50 or below the 50, or are we reacting right around the 50? So when that happens, what I do is I make a general guideline. Whoops. If I decide that price is pulling back around the 50, my expectational area is the fib level below and the fib level above. So I'm looking for the reaction here if that's where price is kind of reacting. I don't want to see this level violated if these same market rhythms to continue. And the reason this is important is when the market has a rhythm, we can use it as a confluence. We can use it as high probability zones. Sometimes the market gives us this quite often. Other times the market won't really have a rhythm and we won't use this confluence. So that's one example. The next example is the market's really trending, let's say, and we're just kind of reacting somewhere in this vicinity. So in this case, I would expect a reaction from the 236 to the 50. I don't really want to see it come below the 50. If it comes below the 50, like, the rhythm is violated. And then obviously the last example is we're reacting below the 50. I want to see the price react here. In these particular scenarios, It allows me to understand that I'm expecting a deep retracement, or I'm expecting a perfect rebalance, or the market's got a really crazy push because a war broke out somewhere and gold's really trending. So now I'm really looking at this 236, 382 zone for a high probability area. I know I don't want to see price come below the 50 if the rhythm is to maintain. At some point, the rhythm's gonna break. This can't be a confluence I use for every trade, but you'd be surprised how often the market will impulse in 3 to 5 waves where the rhythm's very similar. So again, like I said, some people call this the heartbeat. I call it the rhythm. Okay, so this will actually make more sense even more in the next video when we get into order flow. Okay, so if this whole leg is my range, where did this reaction come from? You could say the reaction came above the 236. So what does that tell me? I definitely shouldn't be coming below the 50 if I'm looking for an entry. So if I pulled this leg with that information, I know that if the rhythm's to maintain and that the market is to continue impulsing, the 50 shouldn't get violated. So somewhere in here, I would find a liquidity level. I would cross it with the MA, and I would find a high probability area. Oh, look, it's at reversal timings, which we'll talk about in one of the next videos. This will be a high probability setup for me. So that's essentially how the rhythm works. Don't worry about it too much today. I just want to introduce the concept. It'll get easier when we get on the charts and we really get looking at how the market moves. So for example, when price breaks this point here, you can kind of see the market behavior. So what does market behavior mean? Let's zoom in a bit and let's establish the conditions. So here the reaction came from the 618. This is a deep mitigation. So the market's not really trending. Here, price reacts from the 618 once again. So the rhythm's maintaining here. So the market's still not really trending. What else do you notice? We're still below the MAs. We don't want to use the MAs too much because we want to be really above them or really below them. Then price is not consolidating. Now they're a good confluence. So obviously in this section here, MAs, you may as well just turn them off. Whereas when we break out in the third push, what do we notice about this range push? Two things to notice. We broke through all the MAs, and now we're no longer reacting below the 618 and in between the 786. So we're reacting around the 50 now. What does this tell us? The market's picking up pace. We're no longer walking or jogging, or walking, you should say. You could say we're almost like jogging, kind of speeding up to a run. So this is telling us the push has increased. So with this information, what can I assume? I can assume the next reaction will come out above the 50. So we pull this reaction. So this one did come a little bit below the 50. One thing to keep in mind, when I say come below the 50, I mean I want to see two bodies close below it. If I just wick below it, I don't count that as coming below the 50. To me, that rejected the level. Where it's going to make a difference is if I see two bodies in a row close below the 50. So what does that look like? If I wick the 50 and then go back up, that's still above the 50 to me. If I close below the 50, but the next candle closes above the 50, that's the exact same effect as a wick. Price came below, price came back up, price failed to stay below the level. Whereas two candle closes in a row with bodies, that is a failure of a level, and now I'm going to be looking at other context. To me, this just looks like a liquidity grab. So that's kind of my conditions. You might have different rules. That's what I do. So with this in mind, if the pace is changing, so here we kind of came just above the 50. Here we came to the 50. We wicked below it, but we failed to close. Let's now go to this run. What happened here? Price reacted a little higher. What ultimately happens though, I would pull this now as my range. And what does price actually do here? It does the next thing I told you guys about. You can see how price closed below, took this liquidity out. Then what happens with the next candle? We close above. So this is still a rhythm above the 50. We're not getting 2 body closes in a row. The other thing I want to mention too is this entire trend, we're not breaking the MA. When I say breaking the MA, at least 2 body closes through it. Same thing as a fib level. 1 body close is not enough for me. I want to see 2. Again, these are my personal rules. You can do whatever you want. So with this in mind, I expect price to keep moving in a similar manner. So what do we have here? Once again, price comes to the 50, and you kind of see the pattern. So I know price shouldn't be coming below the 50. This one here is at the 382, but it's a valid level. We have a break and retest. We liquidated people. Once again, high probability setup. What do you have here? Once again, you close below the 50. You fail to maintain the closure. Next one closes above the 50. Safe entry above the 382. Where can you enter? You can enter anywhere in this zone on any of these retests. These would be high probability setups. Do you notice how many setups you got here? So low probability you wouldn't touch. Rhythm establishes here, so you have 1 setup, you have 2 setups, 3 setups. This is an easy catch. 4 setups, 5 setups. There are 5 setups on this leg. This is what I call high probability trading. And ultimately, what happens is at some point, this rhythm's gonna stop, and ultimately, it starts shifting. So here, you would even get one more trade out of this push here. Now here, what does price do? Price shifts and you actually come into the 786, you reject it. You come in below the 50. So now we're getting deep retracements. What happens with this? Price is kind of shifting a bit. We still have a bullish push, but the next thing I want you to notice is this didn't get broken. Eventually this breaks here, but it's a bit of a weak break. What happens? Large retracement. So you can see how price behavior shifted based on rhythm in here compared to here, which is why market rhythm is really important. These are all high probability. This would have me trading with caution, knowing there is a profit taking coming. How do I know the profit taking's coming? We barely broke. When you start getting a change of order flow, there is going to be some profit taking. The trade's getting too crowded. People have to get liquidated. At some point, price reacts and you get back in on the retest, safe entry. You would avoid all this. So that's the idea. So that's today's lesson, guys. Basically market conditions and rhythm in a nutshell. That's about it. So when we're talking market conditions too, this I would consider trending. This to me would be kind of CMC. This would be CMC. This would be CMC bearish. The reason I say CMC bearish on this one is notice how the highs are holding and all the price just keeps wicking lows. So when we're wicking lows and the highs are holding, that can still be counted as CMC. What I mean here is exactly what I showed you. Price is just wicking below. Generally, this means price is reaching lower. This low is as good as it's gone. Failed to break. Price maintains. What did I tell you guys about CMC bearish? This liquidity is protected. They need to take a level out. That's valid. Liquidate. Once that happens, somewhere in here above the MAs and the retest, this would be kind of the safest entry. You know that this would be a safe entry and this would be the target. So that's the idea of the CMC conditions, CMC bearish. It will make more sense. And like this is the 4 hour. I usually find this stuff on the 1 hour. So again, barely break. Highs are holding, price dumps. At some point when price starts coming up, I know this is all gonna get targeted. It doesn't happen right away always, but that's kind of how CMC works. And here, so this I wouldn't even consider CMC bearish or bullish. You have a high, you have a low. Price is just trapped in between. In this particular case, I would just turn the MAs off and I would be looking for shorts in here. I would be looking for longs in here. I would avoid everything in the middle. So that would not be a lot of trading for me in that specific area. So this is something that's going to take you guys some time. There's going to be a little bit of an art for you guys to be able to determine these conditions. To me, they're really easy now. Before I got familiar with it, it took me a bit. The reason this is important is if you have trending market conditions and you're trading a set of rules, if you try to trade consolidating market conditions or consolidating bearish or bullish, the same way you try to trade trending market conditions, you're just going to get wiped. So it's important to establish these. It's also important to understand that when these conditions happen, it's usually either seasonality, so summer, Christmas time, lower volume times, or there's the lack of fundamental drive. Price is just stagnant. When price is just stagnant, these liquidity markets are technically a technicals only market, and you could almost say it's a retail heaven if you just trade the edges. But if you try to trade in the middle, which is where most of retail tries to trade, you can get wrecked really fast. So market conditions is taught before ranges for this reason. We can't treat all the market conditions the same. This is something you guys can only learn by being on the charts. Like, I could show it to you. To me, it's clear as day. It's very simple today. Sometimes it takes a couple days to realize the market conditions are shifting. Same with, that's why I like using the fib. I like to range the market rhythm. I usually know when the rhythm is changing and the trend's about to end. So this is one of the tools that helps me identify that. But yeah, I hope you guys enjoyed today's lesson. Next lesson will be on ranges and internal versus external order flow. That one's going to be a bit more of a complex and longer video. This one's kind of the easy one. But yeah, that'll be our next lesson in technicals. I will see you guys in the next video. I hope you enjoy this.